You're listening to the Generational Wealth Through Commercial Real Estate podcast. Your host, Will Smith, is a former NFL player that found his passion in commercial real estate. Every week, you will learn from industry experts everything you need to know to get started investing in commercial real estate to build generational wealth.
Hey, thank you guys for joining today. We got Logan Freeman with us. He's a real estate agent, investor, developer who has found his niche in the industry as acting as an investment specialist and actually representing buyers instead of sellers. So, man, Logan, tell us a little bit about yourself, man, how you got into this business.
Yeah, well, so, I was a collegiate athlete, got picked up as an undrafted free agent with the Oakland Raiders, did not make it near as far as you did, but, that showed me a lot about myself and who I was as a person. And I was out there for training camp and just didn't make the team. And last calls or last cuts were happening. And, I didn't hear from anybody. And, I got called by the 49ers and they're like, hey, man, because I was an offensive lineman, believe it or not. I was, 335 pounds at the NFL Combine, ran that 5-flat 40. So I was able to move there for a little bit. But, and so I decided to go back, get my master's degree and got my degree at the University of Central Missouri, and then got into the working world. And, I was just in sales my whole life. And so I moved from kind of, sales with a large company, went to a very small company on a startup side, really enjoyed the startup side, got, engaged and figured I needed a more, safe job. So I went to a mid-size, kind of company and was a director of sales there and was there for about 15 months. And, I got fired. And the day I got fired, I called my wife and I said, sweetheart, I got let go. And she goes, yeah, no problem. I knew you were going to. And I was like, what? You knew I was going to get fired. And she said, just check your email inbox whenever you get home. And so I did. And she had already started the articles of organization and the operating agreement, all that stuff for my company that I now have. Wow. And that company started as a consulting company on the sales side of the business. So I was just trying to help folks with their sales process, train their sales people, and put in some technology to help that process, move a little smoother for them. Right. But I also went in and I said, look, I want to get into real estate. So my buddy had a real estate investment firm here in Kansas City. So I joined forces with him as the director of acquisitions and of about a $50 million fund. And these guys were buying single family homes and they have over 265 doors now. And it was my job to find off-market properties, walk the properties, estimate the rehab, and then close and negotiate the transaction. And in less than 12 months, we did over 100 transactions with those guys. So I got a lot of reps on that side of the, just like in football, man, getting all those reps, right? Repetition is crucial to mastering a skill. And so I took all that knowledge and then I said, look, there's got to be a way that I can continue to work with buyers, but on the commercial side of things. And so I moved my license over to a commercial and multifamily brokerage. I started buying some properties myself. And then I brought this idea of working with out-of-state buyers to the brokerage firm that I am at now. And I said, hey guys, I think I could really do a great job with, working with out-of-state buyers. And my broker looked at me and she goes, you're crazy. That's not what we do. And I said, well, just give me a shot, and, thankfully she did. And, I was top grossing salesperson last year, well on my way to continue that on this year, hopefully. Obviously COVID is throwing a little bit of a wrench in our shoes. But I started to also talk to guys that wanted to be more passive in the process and say, hey, I'm still looking for all these benefits, but can I 1031 into a tenant in common deal? Can I invest with you, and not have to actively own something? And I said, well, let me think about that. And I started to read books like, Joe Fairless's Best Apartment Ever syndication book. And I started going to events. I started learning about this structure. I started putting those projects together and we've successfully completed over 7 syndications now. And and we've got a couple big ones in the pipeline. So kind of wear two hats here: the broker hat, where I can help you actively buy something, or if you want to be a little more passive. A lot of professional athletes want to be a little bit more passive. They don't have time to be messing with apartment complexes. We bring those guys in and we go do good projects for them. They still get all the same benefits. So that's kind of what I'm focused on here in Kansas City.
Yeah. I mean, it sounds like our stories are a little bit similar, know, both professional athletes. And, first off, man, let me just tell you, man, that's a huge feat that you completed, man, by being able to even make it to the draft and go through a camp with a team, man, because as you know, less than 1% actually gets to make it to the NFL, man. So
that's right.
Hats off to you, man. It's a lot of hard work,
it is.
I was fortunate enough to be able to do 5 years, and man, it felt like an eternity.
I'm sure.
So man, good stuff, man. So now you did mention something about investors talking to you about tenancy in common.
Yeah.
So could you just elaborate on that for a minute? Because I know some people probably don't understand what that means.
Yeah. So, when you're completing a 1031 exchange, which is a part of the IRS tax code, which allows you to kind of defer your capital gains tax and roll that equity into a new project tax-free, you have to do what's called a like kind investment. And so you can't, sell a plane and buy an apartment complex. It has to be kind of like kind. And so what you used to be able to do that, by the way, you used to be able to sell jewelry and roll it into something else. And so, when you think about a syndication structure, you're actually buying shares of a business that owns the real estate. And so when you're doing a 1031 exchange, you cannot sell an active asset that you own into a business. And so what you can do is what's called a tenant in common. And before the syndication structure, these TICs is what they're known as. It was the common structure that a lot of people did. And until that, there was this, there was not very much regulation around these things. And so there's a saying that said, tick, tick, boom, because they weren't set up very well. And none of the partners can make decisions, because when you do a tenant in common, you legitimately have to take an active ownership into the real estate. And so you actually have, there's not kind of passive partners per se. You have, different types of obligations and rules that you have to go by. You also have to sign on the loan. And so when you're signing on the loan, you're putting your name on the debt and making sure that property is still performing and covering that debt service as well. So, a tenant in common allows folks to pool 1031 exchanges dollars together and then go complete a larger apartment complex. But they really need to be set up as a business, and there needs to be very strong operating agreement in place to make those happen.
Yeah. No, that's well spoken, man. And it's a really good strategy.
It is.
So, what asset class are you invested in now, and why did you choose that asset class?
So, believe it or not, I got started in the hospitality space and syndicated a few hotels here in Kansas City, and it was only because I had some operating partners that were really experienced in that asset class. Looking back now, obviously hindsight is 2020, and hospitality is not doing so hot right now. But historically, hospitality has done well if you have the right kind of product to offer to folks. And so I got started in the hospitality space. Then I moved over to kind of mixed use retail, hospitality, and then like residential. So mixed use residential, where we'd have retail on the first level and we'd have some residential upstairs. I still own a couple of those buildings here in Kansas City as well. But we're highly focused now. I've done a little bit of office, but highly focused on multifamily, mostly because it's a very recession-resistant asset class when you're buying at the right type of property. And so we focus a lot on multifamily and are actively looking in the self-storage space as well. But it's mostly multifamily.
Yeah. And people are going to always need somewhere to stay.
That's right.
It's no getting around that. So you're right about that, man. Just buying in the right asset class, makes the world of difference there as well.
It totally does. And I would say too, we've done quite a few triple net lease neighborhood retail shopping centers, which, the only reason we were interested in those is the long-term leases that you can get put on. These are e-commerce resistant properties that have, Ace Hardwares, Dollar Generals, thrift stores, things like that, but a good mix of tenants. And I still like that asset class. Obviously during, COVID right now, it's taking a beating, but these aren't large big box properties. They're well positioned in the middle of a neighborhood that people can drive to, and they're going to get their haircut there. They're picking up food. They're going to get their lawn stuff, and I'm definitely interested to see kind of where that asset class goes after COVID. And we're going to probably be picking up quite a few of those triple net lease deals here pretty soon.
Yeah. And I think that's going to be, that's always going to be a safe investment for the foreseeable future, just because, you're not competing with Amazons out there and the Walmarts out there. You got, the haircuts and the salons, like you said, people are going to always need those commodity type businesses.
They will. Yeah, absolutely. And, there's some guys on LinkedIn and some folks that I know that do the big box kind of power centers and the malls, and they have their own talking points around that. But, look, I mean, if one tenant has, 30,000 square feet in a building, man, and something like this happens, that's a lot. That's scary, So we just like to kind of diversify the income that's coming in on the property. And look, real estate is not rocket science. It's all about location. So if you get a great location on a property, you've studied the area, the demographics and what's happening in that area, it's hard to really mess up unless you just really overpay. Now, you might have some higher vacancy and a little bit longer time periods for that stuff, but it's also a great asset to have in a portfolio of real estate, in my opinion.
Yeah, I agree. So, you guys are doing a lot of different things. How are you finding your deals, man?
Yeah, so we have obviously the network that we have with our brokerage, and I have 2 or 3 real estate agents that I work with in that office on a regular basis on finding and sourcing properties. I would say that these guys that are agents, they love to know me, and I'm in their office, our brokerage is the same thing because I'm buying their deals. I'm like, look, if you go find me a 50-unit apartment complex that has, is a wedge deal, it has some nice value add components to it, I'll pick it up, and you've got a buyer right here, and I'm not going to put you through the ringer, and we're going to get a deal done. So I've got a couple transactions that some agents have brought to me in my own office that we're completing. So that's one big way is, just networking with real estate agents, even though I am a real estate agent, but telling them what we're looking for. And we do that not only in our office, but outside of our office as well. I've got great relationships with other brokerage firms that says, look, guys, these are our investment criteria. If you really think something hits those criteria, then great, let's take a look at it. So that's one way. Second is just being online and doing a lot of marketing, making sure that folks know what we are trying to accomplish out there. And so we find a lot of off-market deals just by, being in different groups, being on LinkedIn, being on Facebook, being a part of masterminds like Michael Blanc's mastermind, creating your own mastermind. I have a podcast as well, so that helps out. And then I have a meetup here in Kansas City as well that I host every single month. And hopefully we'll be able to get back to hosting that next month, but we haven't done it the last 2 months. And I'm up in front of a lot of people saying, this is what we're looking for. Let's network. So there's a ton of networking that goes on. And Joe Fairless has a great resource that I've taken to heart, and it's 24 ways to find an off-market deal, and I use every single one of those points and try to go through that list. So if anybody hasn't picked that guide up, man, it's awesome. It's a ton of work, but it's all the strategies are there. It's not rocket science. It's all there. You just got to work the plan.
Yeah, for sure. So if you can remember back, man, when you was first getting into this and you said, man, I want to do my first deal, what was your biggest challenge that you faced at that time?
Just the unknown, right? I didn't know what I didn't know. I didn't know how the process went. I didn't know, that there was a legal way to raise capital and that I had to pay for all this due diligence and documents up front and all these things. So I really partnered with a few great partners that helped me, that had 17 years of experience that said, look, we want to find good deals and do them, but we don't want to have to raise the capital. We don't want to have to take this thing from point A to point B, but we will walk you through the process. And I just found great mentors that allowed me to kind of do projects with them, but they allowed me, or not allowed, I told them that I would do the work. And so I did the work for those projects. So I got to learn from their experience, which mitigated my risk, right? Because I didn't know what I didn't know. But those were I didn't partner with those folks until I had already done, 2 or 3 different deals. So it was a learning lesson up front. I bought a couple projects myself and tried to wear all the hats, and when I did that, I ran myself like all over the place, just trying to do too many things. And then I figured out, oh my gosh, there's a better way to do this, and take a smaller piece of a bigger pie that, is a much better asset to own anyways. And I can learn. I'm getting a free education, it's sweat equity, but I'm getting an education while I'm learning from these guys and gals. And that's the way I put it together, man. But at the beginning, I just went out and did it. I'm an action oriented type guy, and I learned a lot through those processes. There were some tears in those processes, and lost a lot of money in some of those deals. But at the end of the day, I probably wouldn't trade that, because I now know what to do. And I know that, working in your strength is where you need to focus on, not trying to do everything about, along a transaction, because there's just so many things that have to be done.
Yeah. And, one point to the listeners here, I want you guys to really dial in what he just said. He went in, and yes, you can do it by yourself up front, but you're going to be, running ragged trying to get everything, because it's a lot of moving parts when you're buying, multifamily, but he said, he wised up and said, man, if I just partner with somebody that's already done it, or they're good at what they're doing, let me partner with them, and then let's do something beautiful together. So
that's right.
Really partner when you can, right?
Absolutely, man. Absolutely. It will help you get past the paralysis by analysis, and it will help keep your dollars in your pockets, because you're not losing them by just going out willy-nilly trying to do everything. So there's plenty of resources like yourself, like me, and in the different markets that you're interested in. Just reach out and start building those relationships. Again, you need to be open-minded to not having all of the deal, but you're also not going to lose all of the deal either. And so when I can get people past that, and I can say, look, you might take a smaller piece of a bigger pie, but you're going to learn. You're probably going to make a good investment, and you're not going to have all of this anxiety, man. I call it transactional anxiety. Part of the big brokerage piece of it is that I don't like doing is, everybody says commercial real estate isn't emotional. And well, those people have never done commercial real estate, right? Because it is emotional. These owners have owned these properties, man. They put their heart, their soul, their blood into these properties. It's emotional for a lot of people. And so there's a lot of emotion that goes on with that. And I get it, that you got to deal with it. You got to be able to, just like an offensive lineman coach used to tell me, he said, wide receivers and quarterbacks can be up and down. They can be up and down, peaks and valleys. Offensive lineman, you got to stay like this all the time, every single play, because you got to block and do your job every single time. So I just try to stay real consistent along the process. And it's not easy to do, but if you partner with somebody who's been through it before, and you have a team that you can rely on, man, that anxiety is not going to catch up with you. And it's so important for your mental and physical health.
Yeah, absolutely, for sure. So, as a company, as an investment company, what markets are you guys focusing on right now?
Yeah, so we're actually focused out in North Carolina with Jerome Myers, actually. Do you know Jerome?
Yeah. I did a podcast with him, when he was one of my first podcasts I did.
Awesome, man. So Jerome's a great guy. Yeah. And what we look at when we're in a market is we really need to focus on the boots on the ground. And so obviously our main market is Kansas City, in a 3-hour kind of radius here in Kansas City. That's our main market, but we're out there looking in Phoenix, Arizona, and Tucson, Arizona. I'm a part owner in a solar company that we're looking to find projects that are master metered. And so we're partnering up with a company out in Arizona to be our boots on the ground in that market. Really been excited about the relationship I've been building with Jerome on the East Coast, so in the North Carolinas. And then obviously the Midwest has just kind of been our bread and butter.
Right. Yeah, man, that's good, man. It sounds like you got a pretty good geographic footprint. So you don't miss a deal, right?
I'm trying not to, man. I'm trying not to. Yeah,
No, for sure, for sure.
absolutely.
Now, when you're looking at your potential deals that you're going to invest in, what is it that you're actually looking for? Is it like a cash on cash return, or is it a deal size, minimal deal size when you're outside of your main market? Like, what are your requirements there?
Yeah, so Kansas City return criteria are a little bit different than the other markets, obviously, just because, well, we can do a smaller deal in Kansas City and just plug it into our machine.
Yeah,
But if we're going to go out to North Carolina, or we're going to go out to Phoenix, Arizona, we need to be able to kind of get to scale really quickly. So that's usually about 100 units
yeah,
for us in those areas. And I would say that for those particular projects, we're really focused on finding projects that we can put our solar systems on and help decrease those operational expenses. Today I posted on LinkedIn, you might not be able to raise those rents like you thought you were going to the next, 6 months. So what can you do though that impacts your NOI? You can decrease your operational expenses. So now more than ever, it's really a good time to hone in on that operating budget and be able to bring those expenses down. So we're really targeting projects that are a good fit from a solar perspective. And what we're trying to accomplish is, from a cash on cash return standpoint, is anywhere between 9 to 12% on an annualized basis. So that's kind of our goal, which prices us out of a lot of deals, which is fine. But
right.
at the same time, we need to be able to have a good enough deal to move into a new market, and so in Kansas City, it's a little lower. We usually try to pay a preferred return of anywhere between 8 or 9% on our project. So that's kind of the goal that we're looking at. And our IRRs from a 10-year hold perspective, with the terminal cap rates being the same or above what we went in at, are usually between 18 and 22%. And so we're looking for those wedge deals that we can increase the NOI by obviously increasing rents through cosmetic upgrades, or doing some sort of new leasing strategy, or decreasing the operating expenses through adding solar, water conservation, putting our property management on the property. That allows us to, really, in maybe year 5 or so, return that capital to our investors, and they still stay in the deal. So, we model it from a 10-year perspective, but we try to always get that capital back for them in year 5 or so. That way they can go invest in a new project. And, after you've returned capital and you're still making distributions, the distributions might go down a little bit because your debt service has gone up a little bit, but they effectively don't have any dollars in the deal anymore. That's really, really attractive to a lot of folks.
Right. Now, real briefly, man, like you said, increasing that bottom line, the NOI number, is going to be what really drives the value in your property. Talk to me for a second about what the solar panels are, the solar business that you're involved with, and how it's reducing expenses on properties.
Absolutely. So, if you think about it, when you're going through a transaction, a lot of folks are asking, okay, is a property separately metered, right? So are those utilities on the owner, or are those utilities on the tenants? And, it's sometimes whenever they say, well, it's master meter property, that's a no-go for a lot of people. They don't want to deal with that, liability, so to speak, of the property having those expenses on the owner, because maybe a tenant will just run the water. Maybe a tenant will just leave the lights on all the time. But there are quite a few of those master meter properties with flat roofs or big parking lots that allow you to engineer and install the right solar system, which basically allows you to offset the costs of those utility expenses that you're going to be incurring. And so not only can you offset a lot of the costs, sometimes close to 100%, there's the ability to get rebates and tax incentives because you are doing something good for the environment as well. And in some states, you can also sell the additional energy that you don't use back to the grid, so to speak. And there's opportunities for that as well. So those markets that we're looking in, Missouri, North Carolina, and out in Arizona, those are great markets from a tax incentive standpoint, a rebates incentive standpoint, and allows you to, obviously implement this type of process. But what you really have to have is the right solar system engineered, because what happened was, 5-6 years ago, when solar started to get really hot, all these big solar companies, popped up, and they started selling these large solar systems to these complexes that they were way too big and they never needed that much, solar on the property. And so there was never any ROI because the cost of it up front was too high. So what you have to do is find the right team, the right engineers to actually develop that and be able to model it and underwrite that going forward. And that's what we've been able to create. Is a system for multifamily syndicators to plug into, by showing us 12 months of their utility expenses, we can design the right type of system, not too big, not too small, but just the right size, which you're actually going to use the solar that you're actually putting on the property. So it's really important to have that upfront cost not be too high and the system be too big for your own property.
Yeah. I mean, that sounds like it can be a very good thing to have on a property. So I'm definitely going to be talking with you more about that, man.
Absolutely, man. Yeah, absolutely.
Sure. All right, man. So when you're looking at your deals, and obviously you finally found the deal and the numbers look like it made sense, when you're underwriting that, what are you looking for, man?
Yeah. So thankfully I have just like I mentioned, I work in my strengths. I've got a CEO and a chief investment officer on my team that they look at about 5,000 deals a year, and they underwrite every single one of those projects. So the underwriting, thankfully, is not in my boat all the time. However, a big thing that we're looking at is okay, what is the deferred maintenance been look like on the property? That's hard to see from a T12, but what you can do is drive the property if you're here local and kind of take a look at that. But then you're also needing to look at the operating expenses that the owner is actually just representing to you, or the broker that brought you the deal is pro-forming, because there's in every single market that per annualized per expense unit for on an annualized basis is somewhere between, I'll say, $3,500 and $5,500 a year. And so whenever I get a pro forma sent to me, or an owner sends me a property and I look at their operating expenses, and it's a 100-unit property and they're $2,500 a year, I'm like, well, there's some stuff that's either not being reported here or not going on. Because if you read appraisers have these rules of thumb that they go by, and those are even a little bit lower. Appraisals will go by, $3,500, $3,800. We're really up into the $4,200, $4,500 mark on our properties to make sure that, we're not skimping on the expenses, because everybody wants to take a pro forma and say, well, I think I can operate it like this.
Right.
But what happens when you can't, And so we're trying to make these deals pencil, but they have to pencil from, our operating expenses. And depending on the year, the location, and the type of property, those will fluctuate a little bit. But we've got great kind of metrics that we put in place to make sure that that's the first thing we're looking at a property. Is like, okay, well, if it's saying it's $2,500 a year, what if we have to double that and it's $5,000 a year? What's the price we can actually pay on that? So that's the biggest thing that I'm seeing. The second thing is grossing up for real estate taxes. In Kansas City, I see a lot of pro formas that are saying, oh, well, your taxes are just going to stay the same, and I'm like, no, they're not. And what happens if they don't? And so you have to really think through that. And so we gross those things up to full freight. And even if that doesn't happen, fantastic. It's just juice for our investors. But you can't just make an assumption that says, oh, they're not going to hit us with a big tax bill, because they absolutely will. And so those are the two things that we kind of start off with, man, is operating expenses and then taxes. And then if we can get past those two, then we'll start looking at the rent study, right? And seeing, okay, well, what is the actual sub-market look like from a rent per square foot standpoint, and what do we think we can get it to? But not until we have those two things taken care of.
Yeah. Very, very good point. Very good point.
Yeah.
Now, there's a lot of guys that's trying to get into the game, and there's a lot of guys that's getting into the game. What are the biggest rookie mistakes you're seeing right now?
Yeah, I would say that we've touched on this a little bit, but it's trying to do everything yourself up front, man. And even if you read all the books, you're on all the forums, you listen to all the podcasts, something's going to come up in that transaction that you're not going to know what to do. And then if you don't know what to do, you're probably going to end up making a bad decision. So either hiring somebody to help you through your first transaction, or partnering with somebody to help you through your first transaction is by far the best advice that I can give somebody. So that's the biggest mistake that I see, is somebody trying to get into the game, do it all themselves, and because they think that they can, and they're just blind to the fact that they're going to miss something along the way.
Yeah. I mean, you're right, man. It goes back to partner, man. It always go back to partner. Even experienced people partner, man. So if you're a rookie, you think you're going to do it yourself, you're making a huge mistake for sure.
That's right.
All right, man. So let's segue to the next segment of the show, is a deal deep dive. So let's talk about a deal you've done recently. What was the value you seen on it? What's the exit strategy, debt, all of that, man.
Okay, cool. So we just last October, we bought a 42-unit apartment complex, and this apartment complex was developed using low-income housing tax credit. So it was a LIHTC deal. If you know what a LIHTC deal is, they usually have a 30-year kind of LIHTC period. Well, This was in the 29th year of that LIHTC. So developed. So it's called a LURA, or a land use restriction. And so I had my eye on this property. I knew the owners of it, and I knew that LURA was coming up here pretty soon. And so we went in, we took a look at the property. It looked like they had renovated it well. I also saw some space in the property that was being used. They had a property management company. They were actually running out of the property. So we're actually able to add 2 more units to that property. And we know that after the LURA burns off this December, we can then start bringing in what's called, quote unquote, market rate tenants. And so the rents were extremely below market. On average, 85 cents a square foot. In that submarket, it's anywhere between $1.10 to $1.25 a square foot. So we knew there was rental capacity to move up there, and it had just been renovated. And so that was really great value for us. And so we have some experience. My partners and I have about 5,000 units of LIHTC over 7 states. And so we knew how to bring this out of the LURA, but you have to be approved by what's called the Missouri Housing Development Committee, so the MHDC. And having that experience with LIHTC, we were able to get approved. And so there was a higher barrier of entry on the buy side. And we went in at a 9 cap on that deal in Kansas City, man. And so super pumped about that 42 units. We've got a couple other of our units added to that deal. The debt was a bank debt here in Kansas City. So we used one of our banking relationships. We got 75% LTC fixed for 5 years, 12 months interest only at 4.25%.
Cool, man. That's a sweet deal there for sure.
It was a great deal, man. So I mean, we bought that deal, and we really feel confident we're going to be able to refinance into an agency loan here in the next 3 to 4 years, and return a lot of capital for our investors. So that's exactly what we're looking for. And that was a 40 unit project that we did here in KC. So we've got a couple more of those on the way. Yeah.
So with them already doing the rehab, you guys really don't have to do anything to bump the rent to market rate?
Yeah. I mean, it's really more of a leasing strategy and the ability that you can. Because right now, by government standards, you cannot. So it was a kind of a baked in rent increase. And so that's great. But also taking some of the rents that there currently are, what's called the FMRs, the fair market rents on the Section 8 or the different voucher programs that we have there, those continually to increase every single year too. And we don't set those. They set those. And so that was another property that we're looking at doing some operating efficiencies on in relation to water conservation and solar as well, because of the landlord, us having to pay those expenses. So, that coupled with the fact that it was under a LURA and developed using LIHTC credits really allowed us to step in, apply our expertise, and take that project down, man. So, we're always looking for more complex deals that we can break down because of our experience that other people maybe, would say, that's just too much for me.
Right. Well, now, what is the exit strategy for that deal?
So my whole investment thesis is we would like to own these things for a lifetime. So, we're going to try to return the capital. We say always around year 5, and we'll model it from the standpoint of a 10-year hold. At that time, we either have a couple strategies. We can buy our investors out, and we can own the projects ourselves, the 3 principals, myself, Parker, and Corey. And that would probably be our goal is to get, the property and own it if we want to. Now, there might be we're buying in very specific locations that we really feel like are going to appreciate very quickly as well over the next 10 years. I say quick, I mean 10 years, but in the next 10 years, we bought in at $65,000 a door, $60,000 a door. I'm already seeing stuff sell at $89,000 a door. So if in 10 years it's a smaller property for us and we get a crazy offer or somebody wants to build in that location, heck yeah, we'll sell it, right? But our goal is to always own these things for the long haul. And so if that means just buying our investors out or going to them and saying, hey guys, this has been a great asset for us, let's just re-cosmetically upgrade this thing and let's just hold it. So our investors will have those options though, and those are outlined in our operating agreements. Right.
Cool. Yeah, man. I definitely like that strategy there, man, where you refinance out your investors and let them have a equity in the deal, because
Absolutely.
It's about building generational wealth. Why else be out here playing this game? I mean, just flipping properties. Yeah, you make money, but if you want to build something that's lasting, man, you need to start holding.
That's right. Yeah, for the long haul, man. Right. We're young guys, so we got a long time to live, and it's important to hold that real estate. I never heard anybody say, man, I really wish I would have sold that earlier. It's always it's always, man, I wish I still owned that. Right. So I think I heard like either Sam Zell or Sam Freshman, Sam Freshman, the guy who wrote Real Estate Syndication, the Principles of Real Estate Syndication. I heard him on a podcast recently. He's in Ruben Greff's podcast, and he said, man, I just wish I would have never sold anything. And so I'm going to try to take that mantra, man. Just hold everything until I can't anymore. And if my kids don't want it, so be it. We'll figure it out then. But at the end of the day, I think holding real estate for the long term is the way to build wealth.
Yeah, absolutely, man.
Yep.
Well, let's go ahead and segue into our last segment of the show. It's a lightning round. A couple questions for you. All right. So, what's the best book you ever read?
Oh man, I'm gonna say The One Thing by Gary Keller. It helped me focus, man. And I try to take that mentality every single day. What's the one thing in and of itself that if I get done today, everything else is easier or unnecessary? And I try to take that mantra every single day. So that was an incredible way to just think about your days and be productive.
Right. What's the best advice you ever been given?
I would say it would be patient with results, but impatient with actions. Patient with results, impatient with actions. It's really easy to kind of compare yourself to all these guys that got, 5,000, 10,000 units on LinkedIn and all that stuff. But who cares, man? You're on your own continuum of success. And comparing yourself to somebody up here, you don't know their backstory. You don't know if their wife's happy with them or their husband's happy with them. You don't know how their family is. Focus on making sure your foundation is extremely solid, and you just enjoy the process along the way. Don't compare yourself to other, but be patient with those results, but impatient with those actions.
Yeah, man, that's a great quote. Great quote. Now, what are some rituals that you're doing right now that's making you a better investing person in general?
Yeah, so one is breathing, and this might sound a little bit weird, but it was always in football, man. It was always, you got to catch your breath. You got to catch your breath. You got to get ready. And I think a lot of folks throughout the day, they don't just focus on their breathing. And so in the morning, man, I really try to center myself after my prayer, and I just really take some really deep breaths, and I realize how that affects me positively. It's just like, breathe in the intention and breathe out the anxiety and the stress, right? And so breathing is definitely one thing I try to focus on throughout the days. And then also my morning routine is crucial, man. I'm a 4 a.m. guy, so I wake up at 4 a.m. and I've got my prayer that I do. I read my scripture, and then I get into my journal and make sure I set my day up for success. But my morning routine, I got a little baby on here in Kansas City, and I got another one on the way, and so those couple hours in the morning really help set my mind up for the day. So those are the two things. And then third is my physical health, man. You got to keep your physical health strong. It's said that if you don't have when you do have your health, you've got 1,000 goals and dreams, but when you don't have your health, you only have one. and that's
Yeah.
to have your health, you know? So
Right.
those are the things that I'm focusing on right now.
Yeah, man. And speaking of health, man, you said you was 330 when you was at the combat. It looked like you lost a lot of weight, man. How much you weighing right now?
Yeah, I weigh about 265 now.
Shucks.
I got all the way down to 219, you know,
Wow.
in my heyday. So I went from 335 to 219, man.
Shucks, man. I'm 330 right now. I'm trying to get down to 265. That's my sweet spot, man.
Yeah. Well, you can do it. You can do it.
Yeah. Most definitely. You know, what is one thing you're doing right now to help you improve your business?
It would be putting systems and processes in place. And what I mean by that is legitimately using technology to capture people's information, to use it as follow-up, and focusing on not having my email run my to-do list. And so it's really important for me to think through what meetings I have throughout the day. If I do have a meeting, okay, I need to move that because that's not adding value to me. I'll do that at a different time. So setting the intention by the morning is really, really important. And then relying on, you know, our CRM, our marketing manager, our consultant, our virtual assistant, our investor portal that we put in place, all of these different things. I've taken the coronavirus time to really put this in processes in place that I didn't have before, that when the market starts to, you know, pick back up from a transaction perspective, which we're already seeing, by the way, I'm ready to start running instead of walking.
Right. Good stuff, man. And
Yep.
last question here for you. You know, if you can give your younger self one tip in regards to investing, what would that be?
Man, I would have to say that I would just follow in the footsteps of successful people. Success leaves clues. And so I wish I would have gotten started with this mindset philosophy, you know, just personal and professional development when I was 16 years old, not 24 years old, right? You know, and so I've got 6 years under my belt now of reading and nurturing my mind. But what if I would have had 15 years already, right? Like that's what I wish I would have done. I wish I would have started reading books and focusing on professional and personal development a little bit earlier. So as my kids continue to get older, I'm going to be finding ways to get all these good books in their brains and that mentality and mindset and focus and discipline a little earlier on in life than I did now. That way they can get to where I'm at in half the time, right? If they want to. But that's probably what I would have said. Success leaves clues. Go find those clues.
Gotcha. Well, man, Logan, we appreciate you coming on the show today. I know some of my listeners may want to be able to get in touch with you. What's the best way to reach out to you?
LinkedIn, man. Logan Freeman on LinkedIn. My website's on there, livefreeinvestments.com. But LinkedIn is by far the most engaging platform that I'm on right now.
Good deal. Well, man, we appreciate you. And that's all we got for you guys today. Take it easy.
Man, thanks for having me.
Yes, sir.
Thank you for listening to the Generational Wealth Through Commercial Real Estate podcast, brought to you by Onyx Capital Investments. Onyx Capital Investments works with investors nationwide to invest in income-producing real estate in emerging markets. Connect online at www.onyxcapitalinvestments.com to learn more about what we're doing. If we have added value to your life, please leave us a review.